Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, November the 17th. Wanted to touch briefly on an excellent week that we had in equity markets last week, with the S&P 500 finishing the week up 5.9% on the week. The S&P 400 had a great week as well, up 5.25%. And the small caps had a great week as well, coming in a little less than the others at 4.3% up on the week. And this was really all driven by Thursday's headline number and core number for CPI. And CPI is the Consumer Price Index, and that's the measure again of inflation on the consumer. And both the headline year-over-year number, month-over-month, and core number all came in less than expectations, which is great if we're looking at what the Federal Reserve is doing with their goal of moderating inflation. And we can start to see that inflation since September has been moderating each month and coming down. So it's wonderful to see that in the equity markets. And you fast forward to this week, and then we get the Producer Price Index, which is the amount producers pay for goods that they are going to produce. And that number came in on a month-to-month basis actually flat, and from a year-over-year perspective, less than expectations, and as well on the month-over-month, less than expectations. And that was another catalyst on Tuesday to send equity markets higher. Now, Wednesday and Thursday this week, you've seen some pullbacks in the market on some Fed speak, where the Fed is still talking about being overly aggressive in fighting inflation to bring inflation down. And so what investors have done is they've said inflation is coming down, which means the Federal Reserve is going to take its foot off the gas a little bit, and they're pricing in an additional 50 basis point hike in December, and the hopes that maybe from here on out, maybe we're only at 25 basis points when they meet in February of next year, or maybe that there's a pause. Now, one of the interesting things that the Fed is going to have to do is to navigate through this time, as we've talked about, monetary policy takes about 6 to 18 months to really be digested into the system. And we've had 375 bip hikes this year. So we went from zero interest rates to 3.75 to 4% this year. And so it's a very dramatic move. And so investors have all eyes on the Fed to see what the Fed's going to do. Are they going to slow down the pace of hikes? And that's going to dictate a lot of what the market does from here to the end of the year, is what the Fed says when they meet in December. We're getting some information that the consumer is slowing down, even though the retail sales numbers that came out for the month of October were up 1.3%, a little better than expectations today. We have seen that over the last 3 months, consumer debt has risen at the fastest rate that it has in 15 years, since 2007, as the consumer deals with higher inflation and the higher costs of goods and services, and has to pay more for these things. So either one of two things is going to happen to the consumers. They're going to continue to borrow, they're going to cut back their spending. Well, we got Target's earnings report this week and Walmart's earnings report this week, and it was a very telltale sign where you saw a lot of more people shopping at Walmart than you did at Target, and you saw Target say the end of October through November has been very, very slow. Well, you can see that also in the real estate market, which is 40% of what makes up core CPI and 31% of what makes up headline CPI in those data, or in that data point in those reports. And when it comes to the data that the Fed uses, they use a 3-month lagging rolling average into housing prices, rent price increases, to determine what they are going to use as a baseline for housing and shelter. If they were using real up-to-live data, housing would actually be a negative lag on CPI, and it would bring down those numbers significantly. So as we move into 23, one of the things I want to point out, even with it being a phenomenal week last week, the amount of divergence that we've seen this year from growth to value in the sectors is amazing. The value sector as of last Friday was down 7% and some change, and the growth sector is 18% worse, still down 25% for the year. So value has been the place to be this year, and expect that to be the case until we can get some more settling out of when we know the Fed is going to be done raising rates and what the rate environment's going to look like for the foreseeable future. So as always, if you have questions about what's going on in your individual portfolio or ways in which we can help you navigate this very challenging market, feel free to give us a call. We'd love to talk to you. You can reach us at 904-346-3460, or as always, check us out online at www.riverplacecapital.com. Have a great rest of your week, everyone. Thank you so much.